right, welcome. Today we are going to tackle one of the biggest questions in all of finance. Maybe the biggest question. What is a company really worth? I mean, we see stock prices flashing on our screens all day long, right? But what do those numbers actually mean? In this explainer, we are going to pull back that curtain on stock valuation, and we're going to figure out how you can look past that price tag to find the real, true value hiding underneath. Okay, let's get into it. So let's just start with a quick thought experiment. Imagine you see a stock, and it's trading at $100 a share. Is it expensive? Is a $500 stock automatically more expensive than a $10 stock? It kind of feels like it should be, but the real story of valuation is, well, it's a whole lot more interesting than that. And yeah, the truth is, you just can't know from the price alone. That $100 price tag, it's just a number. It's a piece of data, sure, but it has zero context. To figure out if it's expensive, you have to compare that price to what the company is actually worth. Its fundamental, underlying, or as we say, its intrinsic value. And that right there is the entire goal of valuation, to figure out if there's a gap between the market price and what it's truly worth. The legendary investor Benjamin Graham, this is the guy who was Warren Buffett's mentor, by the way, he put it perfectly with this quote. It's so simple, but so powerful. Price is what you pay, value is what you get. The price is just the sticker on the car. The value, that's the engine, the transmission, the safety features, it's everything you're actually getting for your money. Our job as investors is to figure out what that value is. And today, we're going to explore the two main ways that analysts do exactly that. Here's the best way to think about it. Imagine you're trying to figure out what a house is worth. There are really two main ways you could go about it. First, you could look at what all the similar houses on the same block have sold for recently, right? The second way is you could sit down and meticulously calculate the cost of the land, the lumber, the concrete, the labor, literally everything it would cost to build that exact house from scratch. In the world of finance, we call these two approaches relative valuation and intrinsic valuation, and we're about to walk down both of these paths. So let's start with path number one, relative valuation. This is our comparing houses method. It's fast, it's pretty intuitive, and it's all based on one simple idea, that similar companies should trade at similar prices, at least relative to their financial performance. We're basically trying to find the financial world's version of price per square foot. And the main tool we use for this kind of comparison is something called a multiple. Now, it sounds like a fancy finance term, but a multiple is really just a ratio. It connects a company's value, like its stock price, to a key number on its financial statements, like its earnings or its sales. This gives us a standardized yardstick so we can compare companies of totally different sizes. Now, the most famous multiple of all time, the one that you have absolutely heard of, is the P/E ratio. That stands for price to earnings. It is the celebrity of financial ratios. It's the go-to metric for just a quick snapshot of how a company's valued, and you'll see it quoted everywhere, on every financial news site. So what is the P/E ratio really telling us? Well, it's asking a pretty simple question. If a company has a P/E of, say, 20, that means for every single dollar of that company's profit in a year, investors are willing to pay $20 to own a piece of it. A really high P/E might mean investors are expecting huge growth in the future. A low one might mean they're not. Or, just maybe, it means the stock is a bargain. But here's the thing. While P/E is super popular, it's got some pretty big flaws. For one, it completely ignores a company's debt. That's why a lot of finance professionals, the real pros, prefer a much more robust multiple. The pro's choice, if you will, is a metric called EV to EBITDA. Yeah, it's a mouthful, I know, but the idea behind it is so much smarter. It's about looking at the business as if you were going to buy the whole thing, lock, stock, and barrel, debt included. Let's break that down real quick. EV is enterprise value. That's the total price tag for the business. It's what it would cost to buy every single share of stock and pay off all of its debt. It's the true takeover price. And EBITDA is a mouthful that basically means a company's raw operating profit before things like taxes and interest payments mess with the number. So by comparing the total price, EV, to the raw operating profit, EBITDA, you get the ultimate apples-to-apples comparison. It lets you compare companies with different debt levels and different tax rates on a much more level playing field. So what's the final call on our comparing houses method? Well, the good news is it's fast, and it gives you a really good read on what the market is thinking right this second. But the bad news, and this is a big one, is that its biggest weakness is that it assumes the whole neighborhood, the entire stock market, is priced correctly. right? If the whole market is in a massive bubble, this method will just tell you, hey, this stock is also ridiculously overpriced, but hey, it's about the same as all the other ridiculously overpriced stocks. It tells you if you're expensive, but it can't tell you if you're in an expensive neighborhood. And that leads us perfectly to our second path, which is much more intense: intrinsic valuation. This is our building a house method. Here, we're going to completely ignore what the neighbors are doing, we're rolling up our sleeves, and we are going to calculate the value of this company based purely on its own merits. Specifically, its ability to generate cold, hard cash. The core idea here is so simple, but it is incredibly profound. A business is only worth the total sum of all the cash it can give back to its owners over its entire lifetime. That's it. That's the whole game. So if we want to figure out its value today, our job is to try and predict all of that future cash and then add it all up. But there is a very important twist. This whole approach, which is officially called a discounted cash flow analysis, or DCF, well, it only works because of one of the single most important concepts in all of finance. It's the engine that makes this entire building a house method possible. And that concept is the time value of money. Think about it. $100 in your hand right now is worth more than $100 you're promised a year from now. Why? Well, because you can take today's $100 and invest it and earn a return on it. So when we're valuing a company based on its future cash, we can't just add up the numbers. We have to discount them. We have to pull them back to what they're worth in today's money. It's how we account for both time and risk.
Now, the whole process, this DCF, it sounds intimidating, but it really just breaks down into 5 pretty logical steps. First, you have to forecast the company's future cash flows for, say, the next 5 or 10 years. Then, you calculate something called the discount rate, which is just a fancy way of saying you pick a percentage that reflects how risky you think the business is. Riskier company, higher discount rate. Third, you have to estimate what's called a terminal value, which is a way to capture all the cash flows from year 10 all the way out into forever. Fourth, you use that discount rate to pull all those future dollars back in today's value. And finally, after a few little adjustments, you get your estimate of the company's true intrinsic value per share.
The great thing about this building a house method is that it's grounded entirely in the fundamentals of the business itself. It's totally independent of what the crazy market is doing day to day. But, and this is a huge but, it has a massive catch. It's famously known as garbage in, garbage out. Your final number is extremely sensitive to the assumptions you make. If you just tweak your future growth rate assumption by a tiny little bit, it can spit out a wildly different valuation. And that can give you a really dangerous false sense of precision. Okay, so we've walked down 2 very different paths, right? One is all about market comparisons, looking outward. The other is all about fundamental forecasts, looking inward. So this leads to the million-dollar question. Which one is right? Which method is actually better? And the answer, as it so often is in the real world, is you have to use both. A smart analyst or really good investor never ever relies on just one number from one model. They use relative valuation to see what the market is thinking and to get a reality check. And they use intrinsic valuation to build a deep, fundamental belief about the business. The real insight, the real magic, happens when you bring the two of them together. And this is exactly how the pros do it. They put everything together on what's called a football field chart. You can see here each bar represents the valuation range you get from a different method. Here's the range from our PE multiples, here's the range from EV/EBITDA, and here's the range from our big DCF analysis. See? By plotting them all on one chart, you don't get one single magic number. What you get is a credible, defensible range of what the company is likely worth. This is what valuation looks like in the real world. So after all of that, all the math, all the models, all the jargon, what's the one big thing you need to walk away with? It's this. Valuation is not a pure science. It's not a machine where you put numbers in and a perfect answer comes out. It is an art that uses scientific tools. It takes judgment, it takes context, and it takes a whole lot of humility. And you know, ultimately, the most valuable thing you get from this entire exercise isn't the final number on your spreadsheet. It's not the price target. The real prize is the deep, fundamental understanding you gain about the business along the way. The process is the reward because it forces you to stop thinking like a stock picker and start thinking like a business owner.
Just think about it for a second. To actually build these models, you're forced to answer the most critical questions about any business. To find comparable companies, you have to really define who their true competitors are. To forecast cash flows, you have to understand exactly how they make money and how fast they can realistically grow. And calculating that discount rate, that forces you to be brutally honest about how risky the business truly is. Answering these questions is what turns speculation into real informed investing.
So let's just end where we started. The next time you see a stock price flash up on your screen, I hope you see something more than just a number. I hope you'll actually pause for a second and ask yourself, what's the story that gets us to that number? Because now you know that the most important question in investing isn't what's the price, it's what's the story behind the price. Thanks for joining me.